That is the closing bell on Wall Street, and now it is Market Domination Overtime, giving you all the moves and information to get you up to speed on the action from today's trade. Got Jared Blickry joining us here to break down the moves today. Jared.
Well, thank you, Josh. We got a mixed board here, and we are losing some steam in the NASDAQ, which is the only major market to close in the green. Let us start with the Dow here. On the Wi-Fi Interactive behind me, you can see it's down 437%, almost 1 percentage point. And I'm going to pull up a chart here of the intraday price action. You can see we started at yesterday's close, basically break even, and we just trended down after that CPI report, kind of zigzagged, and we are closing at or near the lows of the day. So a lackluster end to an auspicious day here. Here's the NASDAQ, which was holding on to gains for most of the day, but then sold off in the last hour, a little bit more than that. And then the S&P 500 down about 0.4%. It slid into the red earlier in the day, and then it finished at the lows of the day, very similar to the Dow. I also want to take a look at the S&P 600. This is a small cap market, down 2.1%. This is the worst day for small caps in almost 8 weeks. And I think that's kind of telling as to the price action that we've seen here today. And if you're looking for a culprit, you could potentially look to the bond market. And I've been talking about the 30-year yield for the last hour. It is now back above 5%. And on a lot of days when it has kind of jumped above that critical threshold the way it has today, we've seen equities roll over, go to the south side, and that is what happened today. What is a little bit uplifting here, kind of a bright spot, is that the US dollar index was also up. You go back to early April and also Liberation Day. In the wake of all of that, we did see the opposite of that. We saw yields in dollar moving in the opposite direction, and that was a whole world selling bonds and the dollar. And that's not what we're not what we're seeing today. So let's check out the sector action, and we can see only tech is in the green there. So we'll take a look at the NASDAQ in just a short minute here. That is up 0.9%. Everything else in the red. Materials down 2%, and right behind it is healthcare, financials after those big bank earnings today. Consumer discretionary down about 0.5%. Energy trade down about 1.5%, and then real estate underwater as well. And as I promised, here's the NASDAQ 100, and you can see there's actually a lot of real estate in the green, and that is thanks to those mega cap names led by Nvidia. Nvidia up 4.04%, and let's check out the market cap numbers. $4.162 trillion for the largest stock in the solar system. Broadcom also up 2%, AMD up 6%. So a very nice day for the chip stocks, but not a lot of else working there. And we'll close here with the Dow. We can see some of those same mega cap names to the left in the green. Everything else to the right, guess what? That's all red. Led to the downside by United Health down 3%, Home Depot down 3%, and American Express also down 3%.
All right, thank you, Jared. Callie, your thoughts on today's trade?
Well, today was basically tech versus everything else, right? The Nvidia news, Nvidia was up about 4%. But if you look beneath that, I think four out of every 5 stocks in the S&P were down. That's not a good day for the market, but if you're an Nvidia investor, if you're a tech investor, you felt something completely different. What that tells me is that there's a lot of worry about what we saw in the CPI report today. Again, we talked about it a while ago, but CPI inflation is basically stalling out, and we're starting to see the effects of tariffs come through in goods side inflation. And I think the market knew this was going to happen, but it still was a little bit of a shock to people actually seeing it come through today. And now some minds are going down the rabbit hole of how far can this go and what does this mean for where the Fed is at and how flexible it can be when it comes to policy.
It was interesting, Cal, because I did see some economists telling their clients they looked at the report and they really said to them there was no big surprises, that there was nothing in the report they said that would impact your views on inflation or your views on the appropriate level of interest rates. And they thought, they added it up and said, okay, they looked at this report and thought, end of the month, you're going to hear Jay Powell basically just repeat the same messaging, wait and see, we need more data. But what do you make of that?
I agree with them in a way. Yeah. The levels weren't that bad. I mean, look at this in a vacuum and remove tariffs from it, then yeah, okay, it was a fine CPI report. I don't like the fact that inflation is stalling, but it's not spiking upwards like we saw in early 2022. I think what caught investors is the fact that inflation and tariff-related inflation is real now, and yet we're still seeing slowing in the economy, in the job market, in consumer spending. That's a really tough bind to sit in. That's essentially stagflation. So I think it was more the realization that this stagflationary feel is here, and investors appropriately reacting to it. I think that's one of the reasons, by the way, why you saw small caps do horribly today and a few large cap techs hold up the broader index.
Then the issue also is, we were talking about this, with the tariff inflation, do you believe it's going to be one time, it's going to be transitory? Because that is, that seems to be like, for example, that's what Waller seems to predict. Or do you think, no, it's going to be something more persistent?
I think it's a little more transitory than some would say, partially because the job market is the groundswell of where inflation pressures come from. And we're seeing wage growth come down, we're seeing hiring stalling, we're seeing layoffs picking up a little bit. I don't think you get those pressures from the job market, so I don't think this inflation or this tariff-related inflation can sustain. But who knows? I mean, we haven't been in this situation in 100 years plus. I mean, tariffs haven't been much of a policy tool since the Smoot-Hawley Act. So I think there's also this worry about, not having any historical precedent to really grab onto and having to face down these higher tariff rates, especially now with an August 1st deadline.
Callie, it was great to have you on the show today. Thanks so much for your time. Appreciate it.
Yeah, always a pleasure.
Come back soon. Meanwhile, stocks closing mixed with tech and banks in focus to end the trading day. For more, we're bringing in now Matt Stuckey, Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management. That firm has more than $300 billion in assets under management. Matt, it is great to see you. And there were some names, Matt, today that were certainly front and center that we were all talking about and that you have in your portfolio, Matt. So your timing here, my friend, is impeccable. Let's start with Nvidia, making news there today. I'm curious, given that it's in your portfolio, Matt, you saw those headlines, resuming sales of some of its chips in China. What do you make of it?
Well, it's certainly impactful, Josh. And just to kind of frame kind of the size of the impact, Nvidia, with their last quarterly update, basically told investors that they weren't able to ship about $8 billion worth of product into China through the H20 product. That looks to be kind of back in the cards in terms of the available revenue sources for Nvidia as you look forward to the back half of 2025 and into 2026. And so, one of the most powerful factors as it relates to kind of what drives technology stocks is earnings revisions. And you can expect those to be revised up higher in the coming weeks as investors collectively look at their expectations over the next 12 months and include in those China-based revenues.
Can I ask you about what you do with a name like Nvidia in your portfolio after the kind of run it's had off that April low, Matt? I mean, do you hold here, you trim, you're adding?
We're long-term investors. We've been involved in the name since the early part of 2019. And so, look, semiconductors are cyclical businesses. Nvidia is definitely one of those. I think what you have to watch for is kind of what's going to drive numbers higher, like we just talked about. And really, as we get into the teeth of earnings season, I think you have to update your models based on what you're hearing from hyperscalers and their comments about CapEx levels. We got through the first part of that earlier this year, and collectively between the major hyperscalers, they revised up CapEx by 20%. That was a very bullish message if you're an Nvidia stockholder. So, let's wait and see how this earnings season shapes up, but that's what we're going to be watching.
Also, Matt, switching gears, JP Morgan, you got that in your portfolio too. They reported today. I'm just curious what you made of that report and also the reaction, Matt. The stock did finish down here, looks like down about 0.8%. I wonder what you made of the report. And then response, Matt, I'm curious, do you think that was really just the run up into the print?
I do think that there's a little bit of a lot of positive sentiment heading into the results. And if you look at the results that were delivered this morning, they were really strong across the board. I think if you look at kind of line by line, some of the open question marks that investors had going into the earnings release, one was whether or not JP Morgan was going to up their guidance for net interest income for the calendar year of 2025. They did that, and they exceeded, in my view, kind of the buy side bogey, which was adding at least $1.5 billion worth of net interest income. The other area of emphasis was kind of what's happening in terms of investment banking revenues. They had guided earlier in the quarter that those revenues were going to be down roughly mid-teens year on year. They actually ended up being up over 9% year on year. And so there's a lot of strength in the back half of the quarter, in the month of June, as policy and uncertainty started to ebb a little bit. And so continued momentum on that as you look to the back half of this year should be well received by investors.
I think you're in Goldman too, Matt. Of course, those earnings on deck. I'm curious to get your thoughts, what you expect to see there. You know, the IPO market obviously showing some signs of life. You'd think that should be good for Goldman.
Yeah, it should be. You do get a little bit of a preview of the Goldman results based on what you heard from JP Morgan this morning, and what you heard from JP that really kind of translate over into the Goldman release tomorrow would be the investment banking activity being better than expected. It would also be really strong markets activity in terms of equity and fixed income trading. And then alongside that, Goldman has a very large asset management business, and earnings on that part of JP Morgan were up 15% year on year. And so, tailwinds that JP Morgan was navigating in those areas should translate well for Goldman Sachs tomorrow.
And switching gears, Matt, we did get that CPI report today. I'm curious what you made of it, Matt, what you think the Fed makes of it.
I think it's a collective shrug if you're a Federal Reserve member. While the core CPI numbers came in, at about 0.2% or so, underneath the surface of that, you are seeing some of those tariff impacts starting to bleed into the numbers. And here, what you have to look at is the difference between core goods CPI and core services CPI. And so, core goods CPI typically is in like a 0% baseline, if not deflationary levels. That's been picking up in recent months as tariffs have started to impact the numbers, but that's being offset by services-based inflation. And if you're wondering kind of 3 months from now how these numbers look, I think if you're a Federal Reserve kind of decision maker, you're essentially going to continue to wait and see how these numbers shape up. But the good news is that heading into probably some higher tariff-related inflation reports in the third quarter, the baseline CPI numbers, if you look at the last 4 or 5 months, do give you some encouragement that inflation, as you head into this, isn't far above your 2% policy goal.
Matt, always great to see you and to have you on the show. Thank you. More Market Domination Overtime. That's coming up. And consumers can be counted on to tell the whole and accurate story of the economy. We're joined now by Philip Carlson-Slezak. He is Chief Economist, Managing Director, and Partner at Boston Consulting Group. And he's here to share some recent findings on consumer sentiment and behavior and how that translates to the real world. Philip, it's great to see you here on set. As investors, Philip, obviously we're always looking for lines of sight into the consumer and how they're holding up. You say here, consumers are not to be trusted on the economy. What do you mean by that, Philip?
Well, so consumer sentiment has delivered a number of false alarms the last few years. Mm-hmm. Remember the inevitable recession that never arrived? Mm-hmm. A lot of times it was pinned on consumer sentiment, which was very low. But in the end, consumers are pretty good at judging their own finances. So if you ask them how they're feeling about their own finances, 75% say pretty good or even good. But if you ask them to judge the economy, suddenly they say only 25% say the economy is doing well.
Why is that, Philip?
Well, I think a lot of it has to do with observability of facts. You know what's on your payslip, you know what's going in and out of your bank account, but why would the average person in the street know much about how the economy is doing? So they're substituting observability with pessimism, right? Yeah. So pessimism, where does that come from? Well, it comes from media, social media, does come from TikTok.
It always comes out of media, Philip, I get it. But that is interesting. Also, and I want to get your take on this when we talk about sentiment readings, you also often hear people say there is a political element to it, correct?
I think that's fair. So if you look at consumer sentiment by party affiliation, it's very clear that it's really a political proxy. Like, which party do you vote for? Yeah. I mean, just an example, inflation expectations. So Republicans this year consistently said inflation would be as low as 1%. At some point, they even thought it was negative, prices will be falling. And Democrats thought, well, and continue to say inflation will be as high as 10 or 11%. Well, neither of these numbers is remotely credible, right? And unfortunately, it's not like you can just add them up and divide them by 2, get an average, right? You can't get at a bipartisan reading by averaging them out. If you add 1 and 10%, it's 11 by 2 is 5.5. So 5.5% inflation is too high. It's outside the range of what's plausibly playing out this year, as we saw this morning. Yeah.
So let me ask you, what do you do with these sentiment indicators? Do I ignore them? How should I approach them?
So I've been telling clients for the last few years, don't listen to what consumers say, watch what they're doing with their money. Right? You can look at consumer spending.
So just focus on what they're actually doing.
What they're actually doing. And if you look at household spending, if you look at retail, I mean, household consumption's been a straight line up since the first COVID dip and the bounce back. It's just been a straight line higher all the way through. Little wiggles here and there, but basically a straight line up. Totally flying in the face of what consumer sentiment surveys said all through those 2-3 years that we've gone through.
And when we talk about the consumer, Philip, oftentimes we talk about it like it's one consumer, but of course, low income, middle, high income. As an economist, how healthy, how resilient are the consumers right now?
Well, I mean, wherever you look, I think you see a lot of evidence that consumers continue to be rather strong. Just think about earnings this morning, big banks reported. Yep. There's very little, there's nothing really in the earnings reports at all that suggests that there's a crack in the US consumer. In fact, if you look at the big banks, charge-offs were below expectations, so you don't see that stress in the credit space for consumers. And so I think that is just one piece of evidence. Evidently, spending continues to be robust. The job market, above all, is really where spending is getting its sources from. So, as long as the job market holds up, I think we're going to see
the kind of what we've heard about the job market, right? It's sort of characterized by a lot of economists who come on the show, Philip, is sort of cooling, not crashing. I'm curious, as you look out in the quarters ahead, is that the trend you see continuing?
Yeah, I think the labor market will hold up. I mean, it came off these extremely strong numbers. We had payrolls and many hundreds of thousands, remember, 23, 22, et cetera. That has cooled, but it's still a respectable pace of hiring. And as long as we add these paychecks to the economy every month at a reasonable clip, consumers will continue to spend. I think we're overthinking it a little too much when we're asking them to look out many years and what are their expectations of inflation, et cetera. They're essentially spending what's coming in. And as long as we're adding jobs and as long as real wage growth is positive, and it is positive, I think that will continue to prop up consumption.
As long as I have you, Phil, let me get your take on that June CPI report.
Sure. I mean, look, I've seen some coverage that suggests, look, 2.7, that's really high, and it's higher than it's been. But look, if you take a closer look at this, the year-over-year number, 2.7. So June 2024 was a very low base period. So to me, the year-over-year number really is driven by what was a year ago. You had very, very little, had a very weak print then. If you look at the month-over-month numbers, they're fine. Right? So the headline month-over-month number is 0.3, in line with expectations. And the core number was 0.2. It's a tenth below expectations. So it's not really possible to say that this is a bad CPI print at all.
What do you think the Fed made of that report?
Well, I mean, look, the Fed is just going to sit on its hands, I think, continue to do that for a while. You don't have a reason to rush to a cut. The economy is holding up. The resilience is pretty strong. Consumers keep spending. So I think this is not going to change that part of the equation.
All right, Philip, great to see you. Great to have you on set, sir. Thank you.
Thank you for having me.
Fresh economic data coming in on Tuesday with June's Consumer Price Index, and tariff proponents may have some explaining to do when it comes to the uptick in inflation. Joining me now is Yahoo Finance senior columnist Rick Newman. Rick.
Hey, Josh. Well, Trump talked to reporters outside the White House today. He said inflation is very low. I guess your guest who we just had, I buy what he said, 2.7%. That's nothing to freak out about, but it's going in the wrong direction. And economists who have been scouring this data, looking for signs that Trump's tariffs are finally pushing prices up, are now finding evidence that the tariffs are pushing prices up. And you can see that if you look at specific product categories that are dominated by imports, such as appliances, such as sporting goods, such as toys. Much of that comes from China or other countries in Asia. And we did see big month-to-month jumps in those categories. You can see some of the charts there. I mean, it might be a little bit hard to read, but in other categories such as clothing and furniture and footwear, we did see the trend of prior months, which was basically no inflation. Now we're starting to get some inflation there. And that is basically exactly what economists say what normally happen when you start raising the tax on imports. So if this continues for a few more months, I think it's going to be very clear we do have tariff inflation. Given all that, economists think that the Trump tariffs as they stand now, that might raise inflation from 2.7% now to, let's say, 3.5%, maybe 4%. So that's a lot lower than the 9% we had in 2022. But will voters notice? I think the answer is some will and some won't. And Trump is going to have to persuade them that even though inflation is going up, it's not a problem.
It was interesting, Rick, because some economists were kind of focusing on the goods categories, and I saw other economists, they were making a beeline for the services, and the disinflation they saw there. They were pointing to airline fares and auto insurance premiums and shelter costs. You mentioned the politics of this, Rick. Just elaborate on this a little bit for us. How do you see that shaking out for the Trump White House?
Well, Democrats are sounding hysterical, frankly. So every time there's like a 1/10 of an increase in the price of anything, they shout that Trump is it's driving inflation up and nobody can afford anything. I mean, that's not true. I mean, inflation is not that bad. But on the other hand, we got as low. So just to go through the recent history here, everybody hated 9% inflation in 2022. Almost everybody saw that, whether it was food at the grocery store, gasoline, almost most things people buy. We got that down to 2.3%. That was the low point earlier this year. And the Federal Reserve, of course, wants to see it around 2%. So we almost got to 2%, and now we're not. Now we're going the wrong direction. So Trump keeps screaming at Federal Reserve Chair Jerome Powell to cut interest rates, but it is Trump's own tariffs that are preventing Powell from cutting rates. So this is all a blame game. Trump is preparing. He wants to have a villain ready to finger if the economy does turn south. Democrats are already, they've been screaming almost since the day Trump got into office that he's ruining everything in the economy he touches. Nobody's exactly right. And I think that it really depends on where does the pain really fall. But it will fall more heavily on working and lower income Americans, working class, I should say, than anybody else, because that's what always happens. And of course, that's a big part of Trump's base. So I think he knows he's going to have to tread carefully here.
Rick, thank you, my friend. Appreciate it.
Hey, Josh.
Time now for what to watch Wednesday, July 16th. Starting off on the earnings front, we're going to be getting a big batch of reports on Wednesday, including big banks like Bank of America, Morgan Stanley, and Goldman Sachs. Bank of America announced results for the second quarter before the markets open. Analysts expecting the big bank's net interest income to rise about 7% from the previous quarter, driven by a more stable economic and policy backdrop. And speaking of the economy, some fresh inflation data coming in on Wednesday with PPI, that's the Producer Price Index. Economists forecasting the June numbers to tick up to 0.2% on a month-over-month basis. The Fed will be watching that pretty closely as it prepares for its July FOMC meeting. Sticking with the Federal Reserve, we're going to be getting more commentary from a couple of Fed officials on Wednesday. This is coming after comments from Treasury Secretary Scott Bessent to Bloomberg on Tuesday. Bessent suggesting that Fed Chair Jerome Powell should step down from the central bank's board when his term as chair is up in May of 2026. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of break, it's Ask You for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.